So with those growth companies, like what specific line items get you excited? Is it free cash flow? Is it their actual earnings? Is actual earnings per share? Like what if you could like create a screen of some sort to like screen a bunch of stocks too that are doing very specific things to help you predict what this might look like or help you choose the stocks to even begin doing more research into? Is there maybe like a line item or two and like what those
Yeah.
line items might be moving toward?
Yeah, I mean, bear in mind this is my whole career, so I can bore you for literally days on this, right? But just to cut to the chase. So if you look at the way we do it is we cover a lot of stocks, and so we try and get a single lens through which to look at all the tech stocks through one lens, all the defense stocks through another. And in tech, really simple. Revenue growth for the quarter versus the same quarter last year, right? It gives you a snapshot of growth. Trailing 12-month revenue growth versus the same period last year. So that's a slower burn measure, right? It goes up, slower, down, slower. Take no notice whatsoever of earnings per share. Who cares? Not even a thing, right? It's just an accounting thing. You can manipulate it left, right, and center. We don't even measure it. We don't report on it. What we look at is in tech companies, we look at unlevered pre-tax free cash flow, which is basically EBITDA minus capex minus changing working capital, which is if you get paid by your customers faster than you pay your suppliers, you have positive change in working capital. If you get paid slower than you pay out, negative. So get paid fast, cash goes up relative to earnings. Get paid slow, cash goes down relative to earnings. Simple. And then we look at the net cash or net debt on the balance sheet. Those are the headline things. The couple of things that we look at that are really informative of the future are what in defense you'd call backlog. In tech, people call it remaining performance obligation. And it's a mouthful, but it's starting to appear now in most companies' 10Qs and 10Ks. You have to, Apple F, Control F for it. It's on page, 732, but it's really interesting. So for any company that has revenue visibility as a subscription model, something like that, or in defense where you have, multi-year order book, look for remaining performance obligation or backlog. RPO measures the total contracts that the company has signed with its customers, total value of those contracts, that's yet to be invoiced or paid, right? And then, the total value of the forward contract book. And then a subset of that deferred revenue is the subset that they have invoiced. Now, they may have been paid for it, in which case it will appear in cash, or they may have yet to be paid for it, in which case it'll be in accounts receivable. But look at RPO or deferred revenue. And that's a little window into the future. Very simple. If RPO is growing, if it's a big number relative to last 12 months revenue, and it's growing faster than TTM revenue, probably growth is going to accelerate. And if it's growing slower than TTM revenue, probably growth is going to decelerate. Now, these aren't linear relationships. They're only directional. It's pretty useful. And so we've used it a number of times in the Growth Investor Pro service, both on the way up. So in 2020, we used it with Cloudflare, that's net, N-E-T, to say this thing's going to accelerate. Look, you can see it in the order book, and it did bigly. And we've seen it in things like Datadog, that's DDOG, and Zscaler, ZS this year. We've said these things are going to slow, and they did. So nothing's perfect. It's a pretty good thing to look at. So those are the things: revenue growth, cash margins, balance sheet, RPO. Those are the things.
Got it. And quickly before Daniel, I'm sure, asks a question, the thing you mentioned too was the net debt. Are you at all like when you're thinking about investing into let's just analyzing, right? A tech company, like are there specific net debt multiples you try and keep in mind that are like the safe zone, or are you really looking for no debt? I mean, what's that kind of like Goldilocks spot?
Yeah, it depends on the company. So if you look at a mature business like an Oracle, let's take as an example. If Oracle's running at 2, 3, even 4 times debt to EBITDA, that's fine, right? Most of these interest costs are hedged out and fixed. The cash flow in a business like that's not going to change anytime soon. It's not going to stress anybody out. With the growthier companies that either don't generate much cash or they've just started to, then you have to look a bit differently and say, well, how much liquid cash is on the balance sheet? Not marketable securities, because you don't know what they are. There might be T-bills, or there might be shares in a private crypto firm. You don't know what they are. So how much actual cash money is on the balance sheet? How much do they burn on average each quarter after tax? And so how many quarters runway do I have? That's a venture capital toolkit, right? But it's relevant because so many companies went public at such a young age, if you like, in the last 5 years, that with a lot of them, you have to look at them as venture capital investments. So is this thing going to need to raise money anytime soon? And if you have to raise money in this environment right now, that's going to hurt the stock, because either you have to raise debt, which will spook shareholders, or you have to raise equity at some even further depressed price. So I think it depends on the company. Mature, low growth, 30-40% cash flow margin software business, big leverage, that's just fine. I mean, don't forget there's a whole LBO industry that makes a living out of 7-8 times leverage, so it's fine. High growth business that doesn't generate much cash, look at how much liquid cash you've got versus the quarterly burn.